What's up, everybody? Michael Silva here. The next big short. Why am I talking about a short opportunity, right? After 7 straight weeks down into the red. Well, you're going to have to watch the entire show to understand why. And one of the reasons here, it's Michael Burry shorting Apple. Who's going to be the winner? Is it going to be Buffett? Is it going to be Burry? Right? We're going to be digging into some very interesting charts today. Now, why is Buffett even a part of this picture? Well, because one of the top holdings in the Berkshire Hathaway fund is 38.4%. This was recorded in March of 2022. Apple is the top holding. So it really is, you know, a big fight there between Burry and Buffett. Double B's, baby. Woo! Now, this is where it gets interesting. You know, a while ago I talked about the inversion of the yield curve. Everyone talked about it. March 4th is when I posted this. Said I felt that it was going to be imminent, right? A lot of people did. And, well, you know, shortly thereafter, in April, it inverted. Both the 10 and 2 and the 35 both inverted. Now, if we take a look at this chart, you can see the inversion. It got above, the 1.0 reading, which is an inversion. And then the Fed staple, the 3 and 10 year, it still hasn't inverted, but it is pretty much going completely vertical. And these are good indications of potential recessions. Now, why is it important? Why are we talking about Buffett? Why are we talking about yield curve inversion? Well, if you understand the yield curve inversion, typically when yields go up, it's good for financials. Okay, but when the yield curve starts inverting, that's typically bad for financials. Now, while the yield curve inverted, I posted this specific chart. I think March 4th, it was part of the same thread. And I said, here's the bear case for XLF. XLF is the financials, right, sector, one of the spiders. And I said, you know, it could potentially bounce around, and this would be the bear case where it distributes down to the lower end. Well, here's an updated chart. It did, I mean, that's pretty crazy, right? I'm not Nostradamus here, but that was pretty amazing here. And you can see financials have been taking a big hit. Now, why is this important? How does it all tie in? Well, if you look at the top holdings of XLF, one of the top ones is Berkshire Hathaway. Down the list here, you can see JPM, Bank of America, Wells Fargo. So let's go to this holding, okay? The second top holding is JPM. JP Morgan is down 30% from the start of the year, from this peak to this trough, even more from the higher peak to this trough. So these financial stocks have been getting obliterated. And if you look at like something like the BKX, okay, this is like the 24 largest U.S. institutions. I believe it's 24 in the U.S., I believe. Now I got to check that. I'm pretty sure. Okay, but this right here came into this red area of resistance. Okay, we've been calling that for about a year now, the red zone, because every time it came up into the red zone, bam, it was in 2007, right before the financial crisis. Right here, the repo fiasco, and then right here was the pandemic, and then we started breaking out. However, we started seeing negative divergences. We started seeing the price momentum oscillator starting to turn back around. And this is starting to look like a gigantic bull trap, showing that we could potentially still head down lower. Okay? And that's a big index to watch. And seeing this weakness is not always a great sign. Now, why am I bringing this up? Well, Berkshire Hathaway and Michael Burry, he's shorting Apple, and he's a very intelligent person. Now, Berkshire Hathaway, one of the top holdings is Apple. So if he's right, Berkshire Hathaway will probably get hit. And when we're looking at a year-to-date basis right now, what do you see? I mean, from 2022, if you go up, it hasn't really been too affected. This has actually been a safe place to be in 2022. Now, this is where it gets more technical. We start to pay attention to what's known as market structure. Okay, we're going to take a look at Brian Shannon from Alpha Trends market structure. I like this graphic. It's on my Twitter if you want to go get it there. Stage 1 accumulation, right? We go through a stage 1, stage 2, and then we start to go through distribution to decline. Now, you can read the intricacies to all of this. Okay, that's totally fine, but I want to play a 2-minute clip of Michael Gayad. I've had him on this show multiple times. It's not of Michael Gayad, it's of his dad, who's worked for, I believe, Bob Farrell of Merrill Lynch, and he explains the market structure. It's an older video, and I really like it, so watch this.
Now, a typical psychology that would prevail during those 4 phases would be, okay, on the news, on the ticker tape, whoops, most active, that stock made 2 points in one day. Immediately attracts attention. What's happening? Hey, that stock is going up. Went down. Well, it's improving. Let's check the fundamentals. Oh, I can't miss that. Buy. Okay? And I'm talking about, it could be here, it could be here, it could be. Some people would even buy here. Okay, some people would buy here. And what? Should I sell here? Okay, and they will sell it right there. That's where we have support and resistance. The chart is drawing itself. Okay, get in somewhere here. Good. We'll hold it. The fundamentals look good. Okay, most likely the fundamentals here did not really come into the picture. In most cases. Okay. So we'll hold it. Whoops! What happened here? It's coming back. Higher, higher. I talked to the analyst. What the hell is happening here? That was a whip. Okay, well, I'm not going to get scared. I'm not chicken. What is this? I'm even now. Should I get out? No, I'm at a loss now. What the hell is happening here? Oops. Okay, I pray God. Well, I'm going to stay. I'm going to be an investor. Okay? Then that process of accumulation could take a few years. Okay, a person who was in the range, let's say 35 years old, he or she, okay, your interest in life different. You didn't have children, you got children. Children went to school, went to universities, and that thing is still damn it down. So yourself, when those people start selling, when that whole distribution process, and not only the people who bought here, I mean, some people bought here and they got greedy. No, we still have a filter. Well, I'm breaking even, I'm losing. Well, I'll stay. Those who bought here, well, it will come back. You know, it will come back. I bought so cheap. Okay, and those who bought here, round trip. And sometimes more.
All right, so welcome back. I want to show you this now, okay? So he explained it a little bit more in detail and the emotions that come from the investing cycle here, or the 4 stages of market structure. And I want to show you ARK Fund. Why am I showing you ARK? Well, ARK and Cathie Wood, right, they led the bull market here out of the 2020 pandemic, but they're also like the poster child of the decline right now. And you can see here, stage 1 was the accumulation phase. Stage 2 is that markup, and you get this blow off top, boom, and then it goes into a period of distribution. This is the weekly time frame, and when it starts cracking main levels, it goes into decline. Now you might be thinking, okay, well, is it the bottom? Well, we might find a temporary bottom, but there is no real, like, you know, decision made yet. There's no, I guess, signs of accumulation at this particular time other than coming into a prior area of support, and we're starting to see some more volume come in too. Okay, so it got hit massively. This is a great example of the market structure. But why am I showing you this? Well, let's take a look at something like IWM. Okay, this is the Russell 2000, very similar type style, right? So the ARK funds has really been, it led the bull market, right, in the 2022 pandemic. It's been leading a decline. And what we're seeing here, IWM, it's kind of following suit, right? We went through this accumulation, we marked up, we went through distribution. The blow off was a little bit later in that cycle, and then we started going through a back breakdown, back test, and now we're in the decline phase. You know, is this showing us that we could potentially head down lower? It's always a possibility, and we need to be very aware of that. But let's dig a little bit deeper here into why we're talking about Michael Burry shirt and Warren Buffett. And we got to pull up Berkshire Hathaway in order to show you that. We've discussed that Berkshire Hathaway is pretty much even on the year, okay? And Michael Burry's coming out saying he's going to short Apple, which shorting in this market is very dangerous stuff. I'm not an advocate of it unless if you know exactly what you're doing. But here's Berkshire Hathaway, okay? Accumulation, bam, very similar to what we've been seeing. Markup, and take a look here at this kind of blow-off type valve that we're seeing here, which is very similar to obviously the other charts we showed, and also part of that stage 2 going into stage 3 distribution. So the next big short, what could it potentially be? Well, it could be some individual equities within this fund, and you got to understand this. You need to understand this. Berkshire Hathaway is huge, okay? We're looking at the top 10 stocks that make up the S&P 100. So these are the top 10 marked by market cap in the S&P 500. And guess what? Apple's at the top of the list. We know that. Google takes up 2 spots, right? And then we have Berkshire Hathaway not far behind. Okay, so having something like this start to get hit to the downside can take the rest of the market down with it, especially if it starts going into some sort of stage 4 decline that we've been seeing take place in some of those other indices. Okay, so what can potentially happen? Well, I'm not saying that it's going to just fall from the sky right here and go straight down. If it's going to play a similar type distribution pattern, and we've already seen this blow off top, what I would expect as the next big short opportunity is potentially to see this start to rally up. And if you read a little bit more in depth about the stage 3, you need to, read these areas right here, screenshot it, read it, right, boom, 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 right over here, to really understand that it's still not approved as distribution. This is more of a question mark, right, before a stage 4 decline. It's starting to look a lot like it, but what can we expect? Well, potentially bounces in this area for who knows how long, and if it comes up to the upper range, these could be very potential good areas to start putting in short positions if you know what you're doing before it starts breaking out of this channel and potentially heading and following the path of ARC, following the path of IWM. Okay, it started with this. It started with ARC, then it started with the small caps. We're starting to see it in the S&P 500. We're starting to see things break down. We have people calling for a bear market, right? The SPY, the SPY, hit a bear market officially on Friday, but then got out of it, which we'll discuss. Okay, so very interesting stuff. I hope that kind of gives you some insight into what I'm seeing. If we look at Apple, Apple was very interesting, right? Apple has been on this big decline right here, put in a huge hammer candle, and I don't think it's going to just go straight down. We're going to see bounces. We saw a bounce last week into this kind of red zone area of resistance. So can we see something very similar happen where it starts bringing back in hope and we get these face-ripping rallies, especially in bear markets, and all we're doing is putting in lower highs. So that is what we need to be watching out for. We don't know when Michael Burry took his short position. At least I don't know if we can know the exact date or his position size or where it's at. Maybe we can look that up. Maybe I got to do more a detailed analysis. But if this starts coming up, that could offer up a good risk to reward to kind of follow a type of trade like that if you're into shorting Apple, that is. Okay, now let's move on to the S&P 500. This here is the SPY, and you can see this is the risk range from last week. Last week, we got outside of the range, but guess where we closed? We closed back in the range. 68% of the time, it closes back within those expected move ranges. Okay, now this is that. That was last week. This is this week. Last week, this week. Last week, this week. This is very similar to what I did on last market cap recap. Okay, what did you notice for between last week and this week? You have another bigger, lower high, which is down about 3% from the previous expected move risk range. So can this bounce up? Can we get some type of move, back here? Maybe even potentially higher, getting outside of it, bringing in more hope and sucking in more people into a bull trap before we're just putting in, once again, another lower high. That is always a possibility that we need to be very, very mindful of. If you can zoom in here, you can see that we did have a nice hammer candle. You can see that we just undercut it a little bit, undercut this previous low. And that right there is actually it's not necessarily always bullish given the thing, but what we've seen previously on double bottoms is you can get an undercut of the low, it flushes out some stops, and then it rallies hard. Now, last Friday we had weekly option expirations, or it was technically the third Friday, so it was a little bit different than every single week where we have the option expirations, and you get some, new positioning, you get some weird price action, and you could see that very well in the smaller time frame charts, right? 15-minute time frame. Everyone was calling the bear flag. It started breaking down. Ha ha ha! No! The market's falling apart, and then all of a sudden, bam! Right back home. Now, overall, we are still in a bearish trend, right? Lower highs, lower lows. That is just the case below a declining 5-day moving average. When you take a look at something like volatility indexes, like the VIX. This is interesting, right? The VIX, although the S&P 500 has been putting in a lower low, the VIX has been putting in lower highs. Now, this could be just, remember the markets move between expansion and contraction. We expanded, now we could be very well contracting. Boom, 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 pow! That's always a possibility here. Okay, so are we going to see some relief here in the very near future, like we showed on these other, previous charts, like for example, ARC, where we sold off hard, but then we rallied big time going into that distribution? Are we going to see something similar in something like Berkshire Hathaway, where you're going to see Apple rally big, and then all of a sudden it's going to continue that distribution phase. Well, it's a possibility. Now, if I look at some other indices like the RVX, this is Russell volatility. Russell volatility is still in the hot mid-30s. That's incredibly high. And this thing is, right, expansion. Now it looks like it's contracting, and something like this can fire off back to these previous highs, which can bring in even more fear, potential capitulation into the markets. And if you look at something like NASDAQ volatility, that is also above the 30s, pushing 40. And this could very well be something like an inverse head and shoulder pattern forming right here, which if that fires off, holy moly, that's going to bring all kinds of fear on a full measured move into the markets. Now, do I think that's going to occur right away? There's a couple of charts that I want to show you here. This is the value line geometric index, and I like to look for divergences between this and then also the S&P 500. I'm not going to dig into as to why. I'm just going to show you what has happened that I've seen in the past. Okay, so currently right now, you can see that we put in a low and a higher low in the XVG. What you're probably noticing out in the marketplace is you saw things like ARK put in a higher low too as well. Meanwhile, the S&P 500 and even the NASDAQ put in a lower low too as well. That would have been nice to see the NASDAQ composite put in a higher low, but it did not. However, the XVG did. Okay, so this right here is a divergence that we need to maybe pay attention to. The last time I saw that take place was back here last year. You had a low and a higher low. The S&P 500 had a low and a lower low. And what came after that? We saw a monster rally. Does that mean we're going to see a monster rally here? No, not necessarily, but you just want to pay attention because this has happened prior, right? Now, to add in a little bit more context to this, what happens if you see a negative divergence? Take a look at the yellow box there. Okay, you can see the XVG put in a lower high, not confirming the S&P 500 putting in its higher high. Now, we talked about this back in January, pretty much at the market top when we were getting those sell signals. And we didn't know that that was going to be a market top by any means, but you can see that that was a clear divergence that we've been calling out in prior videos, and it started boom, boom, heading to the downside. Now, this divergence here, it's only a one candle hit. So it's small in its nature, but it's still something powerful that we need to pay attention to. All right, everybody, that's all I got for you. Leave me your thoughts and comments in the comment section below.